So I first wrote a book about the stock market in general, personal finance, when I was about 14 years old. That covered not just the stock market, but pretty much this whole breadth of financial and personal finance related subjects like assets and liabilities, earning money, spending money, and so on. And a lot of people found the value in that, not necessarily as per the stock market related information, like how to pick stocks, what the stock market is, and so on, but more so about that general breadth of information relating to investments and personal finance as a whole, right? And the book was targeted toward teens. There was a whole range of customers that really enjoyed that for the value of the personal finance information, right? So there were seniors that read it who were like, hey, I didn't know that what a credit score was or what the value of diversifying your investments are. And they really enjoyed it for that reason. And I walked away from that thinking, there is so much information out here about personal finance, but there's also such a lack of common understanding about those subjects. And you are seeing that in financial trends today, right? We're not doing well in the US, nor really the world as a whole when it comes to personal finance, right? Especially younger generations, like your Gen Zers. They're making less money on average. They aren't saving as much. And in terms of spending, right, credit card debt is at an all-time high. College and student debt, right, is just going through the roof. And there's a lot that goes into that. But I think as a whole, the situation would be better and everyone would be better off if we all did understand more about just your basic concepts within that domain of personal finance. And so that's why this video will be the first in a series where I break down the personal finance concepts that I have found most applicable in my life and that I think could help the greatest volume of people. And I want to do this all in a way that is hopefully engaging, right, and enjoyable for you. Finance as a whole has quite a bad rep. Like I remember I presented in a classroom last year about basically personal finance and investing and the stock market and so on, and people were just dead, and they were fully clocked out of that. And I don't think it should be that way, in that A, money is important and personal finance is something you will absolutely do. B, it's kind of fun in theory, right? Like this is you making money, making decisions that will impact you in the future. And then C, there's a lot here to cover that I think can be sort of taught in a more enjoyable manner than you'll get from, say, a textbook or a teacher or many other videos online. So the first video that I want to cover, and the subject of today's video, is going to be that of debt. And debt is a really interesting subject in that it gets a horrible rep overall, right? In that the number one thing in personal finance that you're taught is, hey, debt is bad, you don't want to be into debt, debt is equivalent to bankruptcy and so on and so forth. It's something you should get away from and then go on and live your life with no debt. Now, I think what's interesting there is that view of debt is almost the inverse of the actual applicable nature of debt and how debt is actually used in the modern world today. And I'll explain what I mean there. But to start out, right, the subject, again, of this video is going to be debt. And what I want to make clear off the bat is that I am not for debt in this video. I am not saying, wow, you should go get into debt. But what I do want to do is just bring the contextual awareness, really, and information about debt and how it's used, and the good debt and the bad debt and so on, because it is something, again, like personal finance as a whole, that you are absolutely going to be involved in at some point. So I want you to feel comfortable with the notion of debt because, again, it will severely impact, whether for better or worse, your financial sanctity and health and growth over the course of your life. And then B, I think you'll feel better walking into any situation relating to debt if you know the kind of information that I'm going to be sharing today. And that applies to everyone, whether you're 65 and you've had your mortgage for 25 years and you want to retire, or you're a student and you're thinking about, well, should I take out student loans for college, or should I get a credit card? Should I pay down my credit card bill every month or not, or just pay the minimum, right? Those are all questions that fundamentally relate to debt, and those are some of the questions that we're going to tackle today. So I first want to touch on debt as a whole and how it's used in society. Debt essentially is a form of obligation. It's like, I owe you something and I will return something to you at some point of time. And that doesn't mean you're going to return the whole thing at one point in time. There's a whole variety of setups there. And debt is almost synonymous to credit, right? A credit-based system is, oh, I owe you something, I have it on credit. Those are basically synonymous concepts. And the concept of debt and credit goes back thousands of years, right? People quite literally thousands of years ago, were engaging in all kind of economic activity based on debt, based on basically IOUs. And then as you saw modern stock markets come into play, right, and in the modern financial system, debt became even more important as a concept, and it is really the birth of the overarching financial system and the capitalist system that we see today. And the Ducks were an example of that, where they leveraged debt in a lot of early expeditions and credit in a way that just hadn't existed before. And this notion, not only of the stock market and shares that they came up with, but also just debt and credit as a whole, laid the groundwork for the, again, workings of the modern financial system. And by that, I mean, consider the biggest global, the biggest institutions essentially in the world, right? You have your governments on one side. I'll use a different marker for this, right? You have your governments, you have your banks, right? So that breaks down into your state banks and then into your private banks, right? These generally are, right, the biggest institutions in the world. You have governments that run societies and people, and then you have banks. Here, I'll write that out, of which there are state banks and private banks. And state banks kind of ties into government as well. Beyond that, you also have private institutions. Let's just get a different color out there. We'll call that P for private companies or institutions. And let's think about how debt relates to all three of these kinds of organizations, right? On one side, you have the government. How much debt, right, does the US government have? Let's say 40 odd trillion, like 30 plus trillion, right? And I'll put up a screenshot of what that debt counter looks like right now. There's a pretty cool website where you can see actively, what the debt looks like in real time. The government runs fundamentally on debt, right? And that's not a bad thing by any means. And we'll come back to that. But just as a whole, right, we owe a lot of money. We owe everyone money. And we can do things because we owe a lot of people money, right? The government prints money. They owe the whole, other states, they owe people, they owe companies money. Because of that, they're able to function, right? An example of that is the bond market, right? Government bonds are essentially a form of fundraising for the government, where they get money from people to go do things like, let's say, build roads, and then they pay that money back, just a little bit of it over time. Right, so say you're a city, right, or a town, and you want to build a bridge. Either you can try and raise the money yourself or just fund it out of pocket. But let's say that costs $1 million and you don't have $1 million, right? That's bad. You're not going to build the bridge. Everyone is worse off, right? The alternative is to put out bonds, which are, again, basically a I'll pay you back kind of deal. And then let's say the people in the town buy $1 million worth of bonds, right? The government takes that volume of bonds. They use it to build a bridge. Well, now the consumers, the customers, the people in the town are better off because that bridge was built and the government got the bridge built, and then they're going to pay that back a little bit over time, and therefore they were able to afford that, right? As a whole, that's a win-win, and that basically at scale is how governments operate, right? Now we can think about banks, right? Banking fundamentally is about lending, and we'll get into sort of the Federal Reserve and fractionalization and how really the whole financial system works. But as far as banks go, their whole business model is when you deposit money in a bank, they take that and they lend it out to other people, right, in the form essentially of debt or credit. And then essentially they owe you the amount of money that you've deposited with them, but only when you actually take it out of the bank. So if you take it out of the bank, then they'll return essentially their debt or their credit to you. Meanwhile, they just made money basically leasing your money by giving you a return on it, if they even do that, and then go and giving that out as debt to other people. So banks too just functionally run on debt, on owing other people and organizations money, right? Now in the state case, you see this at a massive scale. Private banks are the exact same thing, right? Every big bank, every bank period will do this. Their business model is that of debt and credit. And then we can think about your private companies. Let me write this out. So, and this ties into the stock market as well, and also just venture capital, private equity, and so on. If companies want to do something, they will leverage oftentimes some form of debt to go and do that, right? Lines of credit are a very simple version of that, where there was a company I used to do some work for, and they, as opposed to raising, I think it was $40 million, what they went and did is they got a line of credit for $40 million. And that just means they can pull on that 40 million if they want to finance any sort of short-term obligations they have, if they want to build a new office, right? They can use that 40 million bucks at a very low interest rate because it's a line of credit provided by another institution to help them grow, but they also still owe that functionally as debt or as credit. So private companies, if they want to generally, say, finance a new office building, or they want to hire new employees, right? They're either going to go to the banks to get that as a form of debt. They can get sometimes loans from governments as a form of debt. They'll go to your VCs, they'll go to private equity players, they'll go to angel investors, and they will either trade money for equity or some sort of deal there, or even a buyout or merger or something like that, or they're going to take on debt. And most often you'll see those private companies, say, going to banks. And what this all boils down to really is two things. One of those is that all the major institutions in the world run on debt, right? The conclusion there is, if all the major institutions in the world run on debt, then everything runs on debt. So beyond everything running on debt, the underlying logic there, and the point I really want to make clear is that, well, if every country and government and private bank, right, and state-run bank and private company, if they all use debt, can it be a bad thing? No. Like that doesn't necessarily mean it's an amazing thing, but the conclusion we have to come to is that it is not totally a bad thing. So what I want to touch on then is the underlying logic or the value of debt. And very soon, we'll talk about how this is applicable to you. But for right now, I just want to focus on that underlying logic. So let's say you want to buy an asset, right? That is, let's call that asset A tilde, right? That asset costs $1 million. In addition to it costing $1 million, despite the fact that it costs $1 million, it will produce for you, and I'm just doing this, off the cuff, so if there's any mistakes, I will catch those later, but it will produce you, let's say, income. So asset A, the income there will produce $100,000 a year, right? Now that's a 10% return, right? So you're buying something for $1 million, it'll make you $100,000 a year. So there are two ways to go about this, right? In one case, let's just say you take the $1 million and you go and buy this asset. So in case one, and this is going to be no debt, right? We buy the asset for $1 million and it makes us $100,000 in the first year. The return there is going to be basically 100 over 1,000, if we want to simplify it, or 100,000 over 1,000,000 to get the idea of, well, how much money are we making per dollar, right? That's going to be 10%, right? So on our $1 million in this first year, we're going to make a 10% return. 10% is great, right? The stock market averages around that. Real estate averages slightly lower than that. Bonds, CDs, debt instruments of that sort are usually, right now, the 5% range, usually less. But 10% is a good return, right? And then let's see case two. And in case two, we're going to use debt. So if you're just buying something for $1 million, you probably have money. Banks probably like you because you have a lot of money. That means if you go to the bank and you get a loan to finance, right, your $1 million investment, they're going to give you a good good interest rate on that, right? And interest rates are essentially the cost of money. They're the price you have to pay to acquire funds. So if the interest rate is, say, 2% on our $1 million, then that's $20,000 that it costs us to acquire that $1 million of debt from the bank. And then if it's 2%, maybe say we pay the 2% back per year, and then we return the original investment at some point in time. So let's say that in case two, we're going to get $1 million from the bank, and we're going to get that at a 2% interest rate, right? So we get a 2% interest rate loan, and then let's say that's 10 years, right? So we pay 2% a year on the $1 million, and then after 10 years, we're going to return that original $1 million to them. Let's now look at essentially how much this costs and then the returns of that. And here, let's get some space right here. If we get $1 million loan and it costs us 2% a year to hold on to that debt, right? 2% of $1 million equals $20,000, which means we get the $1 million now, we buy the asset now, the volume of money we actually paid for that is just $20,000, right? So now before, in case one, right, the math here is 100,000 over 1 million, right? And the return there essentially is 10%. But now, before we had to spend $1 million, right, to get the 10% return. Now our costs are effectively only $20,000, right? So now we're paying $20,000, but we're getting a return of $100,000, right? So essentially we're using $20,000 to get $100,000 over the course of that first year. Well, now the return on that is what? 500%. 500%. Our return just went from 10% to 500% because we're using someone else's money, in this case the bank, to essentially finance that. And of course, what you're going to think off the bat is, well, we have to return the $1 million at some point. So are we really making a better return? But if we think about this, right, that $100,000 that we make, and that's $80,000 from profit in the first year, right? Our costs are 20, our revenue is 100. We can take the 80 and we can go invest it. Now, that money, since we're going to use it for other things, will also make us money, right? So we can take this $80,000, we can go invest it, right? And we can do that every year where we only pay 20 grand, right? So then 10 years down the line, we arrive at a point in case one where, okay, you're going to get 100K a year. That's great. You're going to make your 100K every year and make your 10%. And in this case, we just walked away with $80,000 a year profit for 10 years, right? We return that $800,000, but let's say that we invested in the stock market or in bonds, and that turns into 1.3 million, right? So now after 10 years, we got a loan for the $1 million. We paid that back, but we made 1.3 million in those 10 years. We paid back the million. We have $300,000, and we have an asset that's paying us $100,000, right, indefinitely. So that's just an example of really the spread, and what I do want to highlight is just the spread in returns here, right? This is the power of debt. In this case, you make a 10% return on your money. On this case, you make a 500% return. And the concept here, right, it may sound foreign, like, oh wow, the amount of money you're making on $1 million asset, right? We can think about this in a very simplistic manner, right, through mortgages. Everyone has a mortgage. They're everywhere. We don't think about them really as debt, but that's exactly what they are. You know, when you get a loan from the bank to buy your house, all you're doing is just taking on debt. And the exact same concept applies with every other asset. Let's just consider, right, a mortgage for a house, right? Let's say this is a $5 million house, right? Very expensive house. But let's just say that's a $5 million house. You once again have two things. Let's say you have $5 million in cash, right? The wealth of individual A is $500,000. And they can do two things with this, right? They can buy their house. That costs them $5 million now. Or they can get a mortgage. And their cost for the mortgage is 20% down on a $5 million place. So that's $1 million. And then let's say it's a 30-year mortgage. So they have to pay the remaining $4 million back over 30 years. In the case where they spend $5 million on the house, they have $5 million less dollars. That sucks, right? But they get the house. They own it clear and outright. In this case, you spend $1 million and you now own the house. Sure, you owe the bank $4 million, but you own the house. You can live in it, right? And then you have you spent this $1 million, so you have what left, right? You have $5 million minus $1 million. You still have $4 million, and you get the utility, as in living in the house. So our 5 million, let's say we proceed down this path, right? We use debt. We spend $1 million on the house, we get the house, and now we have 4 million. Well, we still have $4 million in cash, right? We get the utility of the house, we're living in the house, but we have $4 million. Well, now what can we do with the $4 million? Let's say we are risk averse, so we put half of it into bonds, right? And bonds are a kind of debt instrument that I'll cover a little bit later. Our bonds are going to make us right now, or CDs, money market funds, about 5%. Then we take the other half and we're going to put down as stocks. Stocks on average, let's say, will generate 10% a year, right? So we're going to take $4 million and we're going to invest it here. That out of the $2 million, right, the 50% that goes to bonds, we're going to make 5% on it. So that's $100,000. Let me not write this sideways. I'm going to make 100 grand. And then this 10% is earned on half of the 4 million, so the 2 million. So we're making $200,000. And that means in year one, we make $300,000 with the 4 million. And sure, we're paying the bank, every month, every year to pay them back on the loan or the debt for the house, but we just made $300,000. And the purchase price of the house is $5 million. That means we paid for 5% of the house just by taking on debt, right? And that's just what we made in year one. In year two, we'll have slightly less money, but that $300,000 is just what's earned in year one. In year two, we'll have paid the bank, let's say 100 grand. So we have, instead of 4 million, we have 3.9 million. That 3.9 million is going to make slightly less than 300, but let's say 280 grand. Well, now in 2 years, we just made $500,000 that pays for 10% of the house that we can do whatever we want with, right? So, and that's why everyone uses a mortgage. It is just a better use of your money. So in that case, here I'll erase this. It is clearly better to use debt to buy the house. What I want to do now is think about how that's relevant to you, and we can think about just the underlying concept and utility of that. And then I want to lastly touch on some specific debt instruments. So let's say bonds, CDs, money market funds, and then a really core concept that I want to discuss in the last few minutes here will be about is good debt versus bad debt. And let me just write that down. I want to stop thinking about debt as one thing. I want to start thinking about bad debt versus good. Good debt, right? So we have bad debt, we have good debt, and then we have how it's applicable to you, and then we're going to have debt instruments. That's what we're going to get into next. I'm going to resume filming tomorrow. It's getting kind of late here, and I will see you then. Okay, we're back. Today is a Saturday. This is part 2, at least on my end, of the debt video. And like I said, we're going to cover a whole lot relating to debt instruments, to good and bad debt, and so on. What I want to cover first is something I didn't touch on yesterday, and that is a generic perspective and view on how debt impacts general economic activity and performance, right? We looked at that example with the company and the $1 million decision and the $5 million mortgage, but we didn't really generalize that into, why fundamentally is debt better for economies? And to look at that, let's think about 2 situations. One of those situations, let's call that case A, is one in which debt doesn't exist, or at the very least, it's very expensive, right? And then one of those is case B, where we have better debt. And a core concept that's going to be used in this example, and we somewhat touched on this, is the interest rate of a loan or of debt being the price of money. And by that, I want you to think about it like this, right? Let's say we have $100, and let's say you want $100 worth of debt, right? If I charge you $1 per year to own the $100, right? Then that $1 is going to be the interest rate, right? Which means, say, if you're good with those terms, I give you $100 and you say, okay, I'm going to give you $1 every year, and then say 10 years down the line, I'll pay you back the original amount. That means your cost, right, to own this $100 worth of debt is the dollar, right? And since this dollar is the interest rate, you can really think of this as the effective cost of debt, right? The price of money, because Debt, right, it's just a form of, at least financial debt is a form of getting money, of using other people's money, right? So then the cost of that money is the interest rate. And the interest rate, to clarify that, is the amount that you pay every single year to take on debt of that sort. So let's go back. We have case A, we have case B. In case A, let's say interest rates are, let's say 10% interest rates. So that means, say, every year, right, if you want to take on debt, if you want to use other people's money, you have to pay 10% of that. So in that $100 example, if I give you $100, you have to pay me $10 a year to use my money, essentially, for that debt. And then in case 2, right, let's go 2% interest rate. So that means if we want to make $100 or take on $100 worth of debt, in case 1, we're paying $10 per year. In case 2, we're paying $2 per year, right? And that, again, is the price of money. That's the interest that you're going to pay on those funds to take on that debt. Well, let's think about what are we going to do in case A versus case B. And to think about that, let's think about a case C over here. Case C is you can't take on debt, right? There is no debt whatsoever. And now let's say you want to make a $1 million decision as an individual. And that decision is, hey, I want to start a business, right? So you're going to consider starting your business. The startup costs are $1 million for that. You need $1 million to, say, open your location, to hire your starting employees, and so on. You need $1 million. You don't have $1 million. You have 10 grand, right? What are you going to do if you have 10 grand and you want to start a business, but you're very confident this business is going to work out, right? You're not completely confident. There's some element of risk, but generally you're confident that this business will work out with this $1 million investment. In the case of an economy situation, case C, in which there's no debt, right? You're not going to get your $1 million from anyone or anywhere. You just can't. The debt doesn't exist, right? Which means you're not going to start your business in this situation. You can't get the $1 million. You have 10 grand. You're going to keep doing whatever else you were doing. Now, in case A, the interest on that is 10%, meaning to get a $1 million loan, you can go to a bank, you can go to individuals, you can get the $1 million, but your costs on that are going to be $100,000 a year. Now remember, you have $10,000 and you need to pay back $100,000 every year for some period of time and then pay back the original $1 million. That's possible. At least you get the $1 million, but that's such an element of risk since your business has to return at least over $100,000 in the first year just to pay back your loan, right? You're not going to take a salary or make any money. It's overall just a difficult situation, right? And that's with interest rates being at 10%. Now in case B, right, and let's assume in case A, you're not going to start the business, there's too much risk. In case B, with this 2% interest rate, you can get your $1 million from a bank to start your business, and you only have to pay $20,000 a year, right? That means if your business just makes a 2%, say, net return off of that $1 million, you're going to be able to pay back your loan. If the business makes the 100 grand, you're going to have $80,000 left over to reinvest into the business, to pay yourself, or so on, right? So that's not to say that's still a great decision, but compared to these two situations, right, there's such a lower element of risk here, right? So since the risk here is the lowest, right, this is the situation in which you're going to start the business, right? So if we generalize that, what that means is that the more debt there is, right, and let's call this IR for interest rates, and the lower interest rates are, right, then the more economic activity you're going to have, right? So again, the more debt there is, the more available that debt is, the more money you can get for cheaper, right? With interest rates being the cost of money. So if interest rates are lower and there's a lot of debt, just a lot of liquidity in the system, then you can get a lot of money for cheap. You can really leverage the funds that you have, and you can go do whatever you want with that money, whether it's start a business, it's invest in people or assets. And then basically that sums to economic activity. Now, this is at its core why governments love debt, right? Why we run on a on a reserve system where banks can lend out so much more money, keep less money in reserve. And that's also why the central bank in parts sets these rates that the banks use to lend out money. And there's a lot more there that we'll touch on at some point, whether in this video or others. But at its core, that is why debt is so central to economic performance. Now I want to return to a concept that was just briefly touched on in the last video, and that is thinking of debt as in two forms versus one form, right? So thus far, we've been thinking about debt as one thing, where there is debt. It is this thing where you can take on loans, get credit, you can leverage your money, you can go start a business, right? Or get a mortgage or buy a house. But really, functionally, in terms of, well, how is debt going to impact you? How are you going to use debt? And how should you approach these questions of debt when they come up in your life? You should think of it in two ways, all right? You should think of good debt and bad debt. So just to make that clear, we have good debt and we have bad debt. Now, the way I really like to think about this, and the one that I think is the most functionally helpful, is to think of good debt as buying assets and bad debt as buying liabilities. And you'll see why this makes so much sense just in a few minutes here, so bear with me. Generally, right, an asset is something that has value, right? It is something that is productive. If you own a business, that is an asset. If you own a stock, that is an asset. If you have a piece of technology like a computer, right, or a camera, those are assets. So assets are just generally productive things that often make you money, right? A liability is something that you owe. It is something that costs you money. If you have debt, right, that costs you money. If you have a monthly car payment, that is a liability. If you have credit card debt, if you know anything that you own that regularly takes money from you or that you owe to someone else, that's going to be a liability in a functional and, again, applicable sense, right? So then we can think about good debt, right, is debt that's used to purchase assets, to purchase things that are valuable, that make you money, right? Bad debt are things that when you take on that debt, the thing that you're buying or you're using that debt for is going to cost you more money or value in some form. Now, I think this ties at its core to the question of utility versus expected value, so I do want to touch on that briefly. Let me just erase this for 1 second. Expected value is essentially the average return you expect to make, right? So if we have, let me erase this. If we have a lottery where there's a 50% chance of making $100 and a 50% chance of making, here, let's make this 50, right? In this lottery, 50% chance of $100 is 50 on average you expect to make, and a 50% chance of $50 is 25, right? So that brings your expected value from this lottery to $75. But then let's say this is, as opposed to 50, let's say there's a negative number here, right? Let's say you have a lottery, or a game if you want to think about it like that, in which, is this still on screen? Yes. In which say we have a lottery or a game in which there's a 50% chance that you're going to win $1 billion. Here, there's a 50% chance you're going to lose $10, right? And let's not make that 10. Let's make that $10,000, right? So 50% chance you win $1 billion, 50% chance you lose $10,000. Now, expected value purely mathematically looks at the returns that you're going to make. So that would say, just like in the last example, there's a 50% chance we're going to make $1 billion. So therefore, the expected payoff there is 50% times $1 billion. That's $500 million, right? And then the expected payoff over here, where there's also a 50% chance, is 50% of negative 10,000, right? Which means on average, we're going to lose, say, $5,000 from that. So the net expected value of this game is 500 million minus 5,000. That's still what, $499,995,000, right? That's a lot of money. Now, in theory, going off the premise of expected value, we should pay $400 million to play this game, because on average, we're going to make $499,995,000. Now, that doesn't hold up in theory, right? Because people are risk averse, right? Let's say individual I is risk averse generally, as people are. They don't want to risk losing the $10,000 if they don't, say, have $10,000. Because sure, they'd be very well off if they made $1 billion, but if they don't have 10 grand, they lose 10 grand, now they're in debt, and debt is bad, right? Excuse me. So expected value isn't really what we can go off for those things. And you'll see how this ties back to assets and liabilities. The better way to think about this is expected utility. And this ties into sort of information economics and domains of that sort. Generally, what I'll just say is expected utility ties in how you value it personally, right? And that's the value is just mathematically, say how much this is going to make you. Utility is how does that impact me, right? How much do I want this, right? And so on and so on. So in that case, you could have the same lottery, but with expected utility, maybe you really don't want to lose the $10,000, right? So that may skew the calculations. So whereas now, as opposed to the expected value being 500 million, your expected utility might generally conclude to, hey, I don't want to do this because I don't have 10 grand, right? So in that sense, this is somewhat more valuable. So now if we think about that as related to assets versus liabilities, we want to think of assets and liabilities in terms of expected utility as opposed to expected value. And by that, I mean, we can think of, let's say, a house, right, as a liability, and that if you buy a house and it goes down, right, next year in terms of its market value. Let's say it was $1 million, now it's $900,000, and you're paying monthly on the mortgage. You just lost 100 grand in equity. That's not even really yours since you took on a mortgage for it, and you pay every month to own it. That, functionally speaking, ignore the definition, functionally speaking, that is a liability since it loses you money every month. And we can think about assets like that and liabilities, and in a lot of ways we should, but you get to live in the house, right? You get the utility, the value of living in the house. And for that reason, purely approaching that through expected value ignores the utility of living in the house. So we want to look at, again, both assets and liabilities, not just in terms of its return, but how that return impacts us. What cohesively, right, holistically, we get out of either these assets or liabilities. So now let's think about some common forms of debt, right, through the lens of good and bad debt, as in whether it gives you, it's an asset, or you use it to purchase an asset, or use it to purchase a liability, right? Generally, right, if you take out, if you have a credit card and there's a $2,000 credit limit on this credit card, right, and you go to a Gucci store and you buy a $1,000 handbag, right, is that $1,000 handbag going to go up in value? No. You walk out of the store, decreases in value by 20%. Over the next year, let's say, you drop it in a puddle. At the end of the year, it's worth $300, right? That is an asset that will only lose you money. So in that case, and you can make the argument that, hey, expected utility-wise, that you really enjoy the bag. And we'll talk about that in a second. I'll explain why that doesn't hold up. But we can think of that as a liability. So let's go credit card debt slash luxury goods. We can think of that as a liability and a form of bad debt, right? Then we can think about starting a business, right? if you are confident that you're going to make $100,000 with this business, and it costs you $500,000 of debt that you have to, with say 1% interest rate, right? It's a great deal. For your $100,000, you're paying $1,000 a year. You think you're going to make a lot more than that. That's great, right? So let's say small business loan, right, to start a business, right? And then we can think about, let's do a few more, right? A mortgage to buy your house. Let's just write that as house. And then liability as well. Let's say you make $1,000 a month and you book an all-inclusive hotel, right, or a resort that's, $1,000 a night for 3 nights, right? You're going to spend 3 months of your income on something. It's not going to end well. So let's say, just generally, anything you can't afford. We can also do, let's say, a really expensive car, right? A car loan that you have to pay for. Let's say, again, you make $1,000 a month, and this car payment is $400 a month, right? 40% of your income on a car is just not reasonably worth it. These are all examples of good debt versus bad debt. And in some cases, you purchase an asset, and in some you purchase a liability. But we are running into some slight difficulties here, that being, well, expected utility-wise, right? Let's say I really enjoy the Gucci bag, right? Is that worth it then, even if expected value-wise, in terms of its return, it's going to decrease in value, and vice versa, right? There's a risk element to business. What if the business fails? So to just expand upon this model, the way we can think about good and bad debt as purchasing assets and liabilities is within bounds of risk, right? So risk U. Okay, so here we have risk upper, we have risk U. Here we have risk lower or risk L, right? So the way to conceptually to frame this is, if you make $10,000 a year, right? And let's say you want to start a business and you need to take on $10 million of debt to start the business. You're confident it works, but let's say there's a 30% probability of failure. If it fails and you make $10,000 a year and you have $10 million worth of debt that you're financing, that's bad. You're going to be in debt for a long time, right? And sure, you can make the bankruptcy argument, but let's think about that then in terms of, say, student loan debt, right, for college, because you can't get out of student loan debt even if you declare bankruptcy. College essentially is a gamble, it's a game, it's a lottery where you say, hey, I'm going to make that much more money in the future, I'm going to meet people, I'm going to make connections, I'm going to learn, therefore I should spend a certain amount of money. If you make $10,000 a year, right, and you have to go into $300,000 of debt for college, right? That's a gamble. Let's say it's $3 million, right? In a $3 million scenario, $3 million is not worth it, right? For 4 years, if you make $10,000 a year, if you make no money. So in that case, that's too risky, right? That is way too risky. That's $3 million of debt we take on. So in that case, we're running into our upper bound of risk, into the limit of risk within our model that even utility-wise we should consider, right? So again, that's say $3 million, right? When you make no money. If we think about a lower bound of risk, that just means, hey, what is the least amount of risk we'll accept for a given return? Functionally, there is none, right? I just wrote this out so you can see it that way, but less risk is always better, right? If you have no risk without compromising returns, with returns as a constant, that's amazing, right? So really, we only want to think of this through the lens of an upper risk bound, right? So again, with the credit card, let's return to this situation with the Gucci bag. Expected value-wise, it will decrease in value. You're going to lose money. That's not good. Expected utility-wise, you may love the bag. But again, let's say this is $1,000 bag and you make $1,000 a month. Or worse, let's say it's a $10,000 bag and you make $1,000 a month, right? Is going into $10,000 of debt when you make $12,000 a year worth it whatsoever? It might be expected utility-wise, but in terms of how it could materially impact your future, if that goes south, right? You're now in debt that you just can't afford. You have to declare bankruptcy. You might have to leave, whatever place you're living in and so on. All these bad things could happen. And that's because this credit card, this Gucci bag, just based off your income level and based on the amount of debt taken on, hits this upper level of risk, right? It is too risky. So even with the fact that, say, you really, really want that bag, that's just not worth it risk-wise. So I think that is how you can think about good debt and bad debt in terms of not just how it impacts you, right, but also in terms of, well, what's actually responsible, right? That's the risk variable that we need. So materially, I think, again, it is useful to think of situations in which you're going to take on debt or you're considering taking on debt in terms of, hey, is what I get from this debt productive? Is it valuable? Will it make me money, right? Am I buying assets? Or the opposite, right? Is this bad debt where what I get from this debt, whether that's college, whether it's an experience, a material good, or so on, is going to lose me money or decrease in value over time. So let's think of some more examples here, right? If you are a student and you're considering going on a trip, right? And let's say it's a $20,000 trip, you have to go into debt, it's a 6% interest rate, right? You're gonna have to pay 6% of 20%, which is, a few $100 a year. Is that worth it to you, right? Is that worth it in terms of this model where we consider assets with a risk variable and liabilities with a risk variable? Let's say in one case the trip is so you can learn with someone, with some sort of mentor that's going to teach you something. You're going to walk out of there with an applicable skill, right? That's an asset you're going to get from this trip. That is something that will make you more money, that will increase your economic value now and in the future, and you're going to really enjoy that. Let's say you like spending time with this teacher, you like the subject, right? In that case, it's an asset, right? In another case, let's say this is to Ibiza, and you want to go and go clubbing for 3 weeks straight, right? And that's your dream. That's great. Expected utility-wise, you probably love that. Maybe you even wouldn't, right? So there's some risk factor there as well. But generally, risk-wise, that's a liability. That's going to cost you money for years, right? And then it's just too risky, right? So in that case, that would be bad debt. So we have, and you can see in that case, we have a very, one type of debt, one debt decision to make. It can be both good and bad debt depending on what we get out of it. And it really is, again, what we get out of it. So if we think about, again, some of those common decisions that people make, right? Like college. College is essentially a gamble, right? It's a game. It's this question for people at least who have to go into debt for it. Is this good debt or bad debt? And that's based on the outcome, right? If you meet incredible people in college, you meet your best friends, you meet your future spouse, and you would have made 60 grand a year in a minimum wage job prior, or 40 grand a year, and then after college you're going to make 150 grand a year, right? That's good debt. That is great debt. You had this life experience, you met all these people, expected utility-wise, that's amazing, and you're going to materially make more money because of it. But also if you fail all your classes, you don't meet anyone, you're kind of depressed, and then you drop out or even, not even drop out, you finish college, say with an English major or what have you, and you go and you make 60 grand a year, and now you have $300,000 worth of debt, right? Is 300 grand of debt worth it for something that makes you 80 grand? Potentially expected utility-wise, but in terms of risk, again, that's just not really worth it in a financial sense, and in the sense that money is important, and to some extent you do need to support yourself and the people around you, right? So in that case, it'd be bad. Now what that essentially means is the game that you're playing, here I'll make this a little larger, here, right? The expected utility of college is a game, right, where you think some sort of thing can happen. Either you get good debt or you get bad debt, right? And I think what you need to consider in all these situations is there may be many things that could happen, right? Like, let's say in this case, you're going to make a lot of money, you're going to meet great people. That's the best possible case. In this case, you make a lot of money, but you don't meet anyone, right? Is that good debt, or is that bad debt, right? In this situation, right, you don't meet anyone, you're not going to make more money, generally bad debt, right? And so on and so on. Generally, what you need to consider going into situations like these with debt is, well, what do I expect to get out of it? What will it cost me? What will I gain from it? How does all of that impact me? So not just expected value, but expected utility. Like what do I want beyond just the monetary value of those things? And then what are the probabilities in your mind of all those things happening, right? That's a very pragmatic way of approaching risk. With at its core, the question being, am I purchasing something valuable, or am I purchasing something that will add to my life in a monetary sense as well, in a utility sense as related to risk? I know I'm beating a dead horse here, or the opposite, where that's just not worth it, right? So I hope that model can help you when it comes to considering debt in your own life. Now what I want to do is touch on some of those debt instruments, right? So these are things like bonds, CDs, money market funds, and so on. So essentially, there are a number of asset classes. I'll touch on this, I'm sure, more so in another video, but we can think of this as, right, the stock market, which are equities, equity just being shares of a company. In the case of the stock market, it's just publicly tradable. We have real estate. We have, let's say crypto, and we have collectibles. And then we have, I think I lost you there, we're back. We have varying others. And then we have debt instruments, right? All of these really are debt. Real estate, you buy everything with debt. In terms of the stock market, these are private companies that use loans, use debt to do things. Crypto and collectibles, less so about debt, but in terms of luxury things, right, and especially trading and things like crypto, you use a lot of debt for leverage, sort of margin trading. Then you have debt instruments, right, and these are the asset class that I want to focus on. So that's just a genre of investments. Now, debt instruments are basically all loans that are used in the financial world for people, for companies to do things, or even the government to do things, right? So debt instruments sounds very fancy. All that means is financial tools, financial things that incorporate debt, right? And the main one is a bond, and all a bond is a loan, right? So let's say, and we talked earlier about the issue, or excuse me, the bridge that the town wants to build, and they issue a bond or a debt essentially to make that bridge. Let's just generalize that into a bond is a loan. That's literally all it is. It's an IOU, where let's say I am a company. I want $100, right? I want to make $100, or excuse me, I want to use $100 to go and hire a new employee who, let's say, theoretically is going to work for $100. So right now, I want my $100, right? But I don't have $100. So where am I going to get the $100 from? Let's say we have, let's call him Bob. Forgive my lack of imagination, but we have Bob right here. Bob has $100, right? Bob says, okay, I'll give you $100. But on certain conditions. Those conditions being, we have year 1, year 2, year 3, year 4. On year 1, you're going to pay me 4%, On year 2, you'll pay me 4%. On year 3, you'll pay me 4%. And then on year 4, you give me back the $100. And this is 4% on this amount. So what that means is, I as a company can get this $100 now, but then I pay $4 in year 1. I pay $4 all to Bob in year 2. I pay $4 in year 3, then I return the 100 in year 4. That means my effective cost, right, is $112, meaning Bob makes $112. Over 4 years, Bob makes a 12% return, right, or a 3% return per year. So Bob's happy because he just made money. Now let's say this employee for me goes and makes me $10 a year, right? I just spent $4 a year to make $10 a year. I'm happy overall, right? So, and that ignores that you have to return the principal. So let's say it's $50 a year the employee makes, right? It's profitable for the business. The business is happy. Bob is happy. He makes a return. The employee's happy because they get paid. Everyone generally is better off. And that is basically what a bond is. It is just an IOU with a set repayment schedule, except what the actual model by which bonds function in major financial markets is in the debt instrument of bond, or the asset class, you can think of it as, is a company, a state, etc., will issue a bond offering, right? And they'll say, we need $100 million, and we're going to pay you, let's go back, 4% a year, and we're going to do that on an annual basis for 10 years. So that essentially is a government, a state, a business, etc., being like, hey, we need $100 million. We need to do something with that money. We'll pay you 4% a year, and then 10 years later, we're going to return that $100 for you, right? And then they put that on a market online where a whole bunch of investors can be like, oh, the state of India wants $100 million for 4%. You know, I'm going to throw in my 4%, and then, or I'm going to throw in, let's say this is $100 million divided into 100 million shares, so it's $1 a piece. Investor A might be like, I'm going to throw in $50, right? I'm going to make 4% on my $50 for each year for 10 years, then I'm going to get back my $50. Someone else might throw in $1 million, you know, whatever those numbers are. And then the state of India goes and uses the $100 million, does whatever they want, and life is good for everyone. That's obviously a very simplified view of bonds, but that is pretty much exactly what it is. You can get really short-term bonds, 1 month, 3 months, 6 months, 12 months, all the way up to, say, 30 years. And a core concept in bonds is the credit worthiness of the issuer, right? The issuer being the one, the business, the state, et cetera, that says, hey, I want money, here's my loan offering. So AAA is like, the best rating. Anything lower, just the worse the letters get, right? B, C, D, et cetera, the worse off you are. AAA is great. That basically means they're 100% going to have the money to pay you back, right? Because anyone can say, I'm going to pay you 10% a year and give you back your money in 10 years, right? Do you actually trust them, right? Now, your credit score, the credit worthiness of your business, right, or your state or your individual is just, well, how much do I trust them based on their history to pay back that amount of money? And you can see that in the terms, right? Like credit worthiness. Credit just kind of means debt, or like on credit. That just means how worthy are you in terms of debt? How much can I trust you with my money? So if you have again, the state of India, right, versus the United States government. The United States government, not AAA anymore, but it is as good as it gets when it comes to your credit worthiness, because no one thinks the U.S. government is going to fall. They're like, hey, the U.S. government is always going to pay us back, therefore they're they're trustworthy. I will trust them with my money, right? The state of India, slightly less trustworthy. They're still generally trustworthy, but let's say let's just think of this as a single A versus AAA, right? The more trustworthy you are, the issuer is on the bond market, the lower rates, right, they can offer interest rate wise. So let's say the United States government is going to pay 2%, and the state of India is going to pay 4%. Now it's again not actually that much of a difference, but in this case with the 2%, we're very, very certain that the U.S. is going to pay us back, right? So we're going to go 2%. Here, there's an element of risk. We don't know if they're going to pay us back. They could default. They could, just a lot of money and be in a big deficit and decide just default on their loans or debt. So we're going to charge 4%, or they're going to have to charge 4% for the market to want that debt. Now with India, it makes less sense, right? But if we think of that in terms of a startup versus Apple, right? Apple can offer 2% and people will still buy those bonds. If a startup offers 2%, everyone is going to go to Apple, right? Because Apple is more trustworthy than the startup. And this is in terms of a public market, again, not, say, a private investor that wants equity, say, in the business. So that's bonds. I also want to touch on, that is bad handwriting, but money market funds and CDs. A CD is a certificate of deposit. It is basically the same thing as a bond in terms of how it impacts you, right? You buy them and there will be some sort of return, there's some sort of amount they pay you per year, just percent-wise or dollar-wise. There will be a cost to purchase it, and then there will be a repayment, a date at which they repay some amount, right? So this could cost $90. It might pay you $4 a year, and it'll pay you $80 in 10 years, right? So it costs $90, you make $4 a year for 10 years, so $40 total, and then you make your $80 back, so that's $120 you make off your 90, that's 30 over the 90, and right, that's a 30% or so return over those 10 years, which averages out to 3% a year, right? So that would be a basic example of a CD. You can basically buy them anywhere. You can buy a bond. You can buy all types of these things in brokerage accounts. So Charles Schwab, E-Trade, Fidelity, Vanguard, and so on. Now, in the case of both CDs and bonds, right, you do get your money back at some point in time, right? There is now, and then there is, let's call that, there is repayment, right? So you spend money now, you make money here, you get your money back. But you can't take your money out prior, right? Your money is stuck in there. You can, in some cases, sell on a market, but let's just think of this as terms of, hey, your money's stuck for 5 years, 10 years, et cetera. Money market funds are not like that. Money market funds are 100% liquid, and that's MMF. Again, that is very bad handwriting. A money market fund is also a debt instrument in a sense, but let's say it pays 5%. If you put your money in a money market fund, it will make 5%, say, every day, basically constantly, right? But let's say it pays out every day. So you're going to make 5% over 365 days every single day, right? That's your daily return. So while for a bond you may get paid out every year and you get your money back in 5 years, in a money market fund, you can take the money out in a week and you will have made, right, 5% over 365 times 7, right, times 7 days for the week. Now we are living in a very strange environment right now when it comes to your bonds, your money market funds, CDs, just returns as a whole. Historically, bond returns have been much lower. Right now, they're well over 4%, right? And money market funds are at 5%. That's a really good return. You can throw $1 million in and you're going to make 40,000 a year off bonds or 50,000 a year off a money market fund. It will probably not be like that forever. That's just because the feds are taking the reserve rate, which is the amount of money that banks are required to keep in reserve when they lend out money, and they're keeping that very high, right? Because they're trying to still bring down inflation, right? So this ties into monetary policy and fiscal policy as a whole, right? The federal bank generally wants to keep inflation low. Since they're not seeing low inflation, they are making the price of money or interest rates high. When it costs more to make more money, there's less economic activity. When there's less economic activity, in a sense, there is lower inflation. That's a very, very, very simplified look at that. But that is why, essentially, right now you're seeing these, especially in part, these very high returns on debt instruments. So the last applicable question surrounding debt or context that I want to provide for you is that of credit. And we just touched on this a few minutes ago, as in your credit worthiness, your trust is associated with the good rates you can get if you're issuing bonds, or the cheap versus expensive nature of those. The generalized view on that is the more people, the more institutions trust you, right? The better rates they're going to give you. The cheaper money is going to be, the better rates on all forms of debt you can get, right? So if your mortgage, let's say, could be 4% a year, right? If the bank really trusts you, if you always pay your money, your debt, your credit card payments back on time, right? And you've done that for a long time and you make a lot of money, maybe that's 2%, right? Now, if they really don't trust you, if you never pay your debt back, etc., maybe they won't give you the loan for the house, or maybe they'll charge 8%, right? And that's just based on how much they trust you. Now, the metric that they use to assess your credit worthiness, right, is your credit score. And this, functionally, you've probably heard about a credit score, but this is why credit scores are so important, right? This is how banks, how the government, how institutions, how individuals assess how much they can trust you with their money. And the lower your credit score is, right, the higher interest rates are going to be, the more amount of money you're going to have to pay for debt. And if you want to buy a house, if you want to get a car, any sort of tech, right, credit cards, loans for businesses, right, if you have a low credit score, you're either not going to get that kind of debt or you're going to pay a lot of money. That's not good, right? So the higher your credit score is, right, then the less money you pay, and theoretically, the more money you're going to make. That is why you want a good credit score. Now, your credit score breaks into a whole number of things. The number of cards that you have, the length of your credit history, so how long it's been around, your payments, and whether you never pay back on time or you always pay back on time, your utilization, and that just means if you have $100,000 of credit available on your credit card and you spend $1,000 a month, that's 1% utilization or usage in a sense. If that's 50 grand that you spend, then that's a 50% utilization rate. Generally, you want to keep utilization somewhere around 30% or less. That is usually best. Payment-wise, always pay back on time. And I highly suggest, especially if you're younger and you're working through your first few credit cards, always pay the full balance back every month, right? So if you spend $300 this month, don't pay the minimum like $20 that you have to pay. Just pay the $300 back, right? Length of time, right? More is better. If you've been paying, or you've been on time with your payments for 10 years, that's better than being on time with payments for 1 year. And then for number of cards, there's a lot of variables that go into that. Generally, there's a soft credit pull and a hard credit pull, right? When you open new sort of credit accounts. Now, a hard credit pull, if you are opening a credit card, means they do basically a full check, right, on your credit history. Hard credit pulls make your credit score go down. Soft credit pulls do not. Some cards you can get for a soft credit pull. For other ones, you just have to get a hard credit pull to say just get the card if you say don't have, right, a credit card. Generally, if you open a bunch of cards and those all require hard credit checks or pulls, right, your credit score will go down. That will climb back over time, but in accordance with these other variables. But in some, that would be the factor there that really drops your credit score. There's a few other elements as well, but generally it's going to be these things. So just generally, if you pay your payments on time, if you use less than a third of the credit line available to you, and then you just keep at it and build that length, and also just have, say, sub 4 cards, right? You're generally going to have a great credit score. Credit scores generally operate on a scale where 850 is the max. If you're in the 600 to 700 range, that's just about average. If you're 700 to 800, that's great. If you're 850, you're quite literally perfect in a credit score sense. So those are the general ranges that you're going to want to aim for. Okay, so that will wrap up this conversation about debt. I think generally, if I had to summarize what I've been trying to say in, say, 60 seconds, it is that debt is neither totally good nor totally bad. If it is anything, it is everywhere. It is what every institution, in large part, every government and a lot of individuals run upon it. It is the blood of the financial system, right? So you can't ignore it. I think it's really more a question of, well, how do you use it? How do you use it to your advantage as opposed to something that takes away, right, from your financial health and ability? And if you use it right, you can do a lot with it, right? It is very powerful. And in another video, I'll go over some examples of how I've, say, personally used debt, right, to accelerate returns, like by buying a business. So in terms of how you approach debt making decisions, again, good debt, bad debt. Good debt helps you in the future, it makes you money, it brings you things, it increases your value, right? Bad debt is debt used to purchase liabilities, to things that take money away from you, that take time and effort and so on from you. So that's generally, I think, the easiest frame for good debt, debt as a whole. And then as the final note there that we touched upon, just make sure your credit score is good. That really does matter when it comes to debt. That is the video. Again, this is the first sort of lecture in a series that I will be doing on personal finance. Just let me know what type of videos you want to see, what concepts there. Some ones I want to do are assets and liabilities, taxes, the banking system as a whole, and then just varying ways of, I think, making money as well. So again, just put in the comments what you want to see. Please do subscribe if you want to see more, and I'll see you in the next one.